I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. Welcome back to the show, Ted.
Well, it's good to be back, Jim.
The federal government has projected a higher than expected economic growth this year, but you were always hot from the start of the year on that, weren't you?
Well, that's right. You know, we've been talking about this here on HowStreet.com for a long time, that the Canadian economy was going to surprise on the upside, and lo and behold, it has. Now we've got the central bank, of course, hedging its bets because it doesn't want the Canadian dollar to go flying too high. They did their little trick to get it up in the mid-70s for the NAFTA negotiations, and kept going. So our central banker, of course, loves a low dollar, and I'm sure he through those interest rates increases on, sort of kicking and screaming. But the reality is, the Americans would not have been. They would have been even in a more crankier mood, let's say, if at the negotiating table had the loonie been flirting with 70 cents, which is, of course, sort of sub-70 is Apollo's dream world where we all become poorer, except for a few people in the, a few exporters and the like. They would do very well, of course, and it would be great for offshore home buyers who could snap up more Vancouver real estate at reduced prices. But the central bank governor unfortunately had to, stop that game for a little bit anyway, at least while the negotiations are going. And I think we'll see the Canadian dollar in a range because the economy is too strong to justify emergency type interest rates and ultra low interest rates. Of course, it all depends where you are and what sector you're in. But the Canadian economy is doing pretty well, and the labor market, even the Bank of Canada admits it's getting tighter. And for some reason, and I think the street has been all behind on this. They've been getting whipsawed. They read the Bank of Canada statement as being dovish. Well, I read it and I thought, well, now they're just kind of leaving themselves open to do whatever they need to do to keep the currency behaved in that sort of 77 to 82 cent range, with a skew to the lower end, I'm sure. But the fact of the matter is, we've got a lot of fiscal stimulus coming our way. You may not like that, or you may love it, depending on your views of that. But it's coming, and for such a long time, we've had such a negative view. Not we, but I mean, there's been a consensus view on the Canadian economy that's so weak and feeble that no one's, very few people have taken the Canadian stock market seriously, Canadian consumer stocks. Everyone, is enamored with Amazon and Netflix and a lot of Canadian money pouring into those U.S. stocks. Well, I can tell you that, what we track we track both Canadian and U.S. stocks. And when you look at Amazon right now, we've got a mixed outlook on it. Investors should be prepared for disappointment on Amazon. Mixed outlook means stock could basically go either way, but it's no longer sort of the slam dunk momentum play. And one of the reasons is because that old-fashioned brick and mortar retailer, Walmart, is upped its game. We have a sunny outlook on that stock. It's not a recommendation, by the way. That's where it ranks in our VIP rankings: value, insider commitment, and price momentum. Now, what does that have to do with Canada? Well, a couple of things. First of all, right now we've got a sell signal from the industrial sector in the U.S. And why that's important is because we really get very few sell signals from insiders that are meaningful. And when you have the industrial sector flashing insider weakness, like we see now, the signal's been pretty good. It's not infallible. The last time we had this signal, it was in early summer, and the industrial sector dipped about 3%, which, in this market is a massive sell-off. Just joking, but the market did go down, and then the signal cleared, and we pulled it off. But our report was a few days later, and the index was still down about 2%, but then it climbed from there onto new highs. But we're getting the sell signal again. So I think everyone who is down on Canada loves the U.S. because the U.S. is always in better shape than we are. That trade is over. The Canadian market is going gangbusters. So you've got to look at Canadian retailers. You got to look at those that are going to benefit from the type of stimulus we're having, and we're getting, so this federal government, whether you agree with it or not, it loves sending checks to lower middle income Canadians, and guess what, Jim? They don't sock that away. They spend it, and or pay down debt, but a lot of it gets spent, and that's good for Canadian retail. And so there's a theme that no one probably took seriously 2 or 3 years ago. But, Canadian retail stores are probably enjoying this stimulus coming out of Ottawa, and why wouldn't they? So we've got a much more constructive outlook on the Canadian market, although we do have it on watch for a downgrade to fairly valued. So if you're a value investor, those opportunities are rapidly disappearing. We suspect that unless there's a recession in the U.S. Or globally, and I don't see that happening anytime soon, that we will get momentum players moving into the Canadian market. And we just posted on our website, CanadianInsider.com, a little tidbit on the basic materials sector, which your listeners can go to our website at CanadianInsider.com and download the report for free, and to take a look at where insiders are buying in that sector. In our case is basically look, we've got Donald Trump in the United States boasting about record defense spending growth in their new budget. Whether that's actually the truth or not, I haven't fact checked it, but let's just assume that that they're planning to spend more on the military. When you have that combined with entrenched entitlement plans, which the Republicans are finding very hard to roll back, you've got a situation where you've got the U.S. government that's beefing up its military and also boosting, and paying these entitlements, which are growing because the population's getting older. And last time the Americans did that, big time anyway, was in the 1960s. And lo and behold, what happened? We got inflation. So I know there's still a huge camp out there that we're doomed for deflation and then everything is going to be spiral. We're going to have a downward spiral in prices and inflation's dead. Well, it's more like a bear in hibernation, I think, and it's been lulled to sleep by the Fed with its quantitative easing and the dreadful ECB and its, a never-ending quantitative easing, negative interest rate, manipulation and assault on free markets, which unfortunately still not, the end of that is still not in sight. They just had a meeting and they're dragging their feet, and the Bundesbank dissented, and it's just been a big mess in Europe right now. And but Draghi's doing this to try and keep markets afloat, and you let the Fed try and taper its balance sheet. So you got the ECB cutting back its bond buying, to 30 billion euros a month. Well, that's still a huge amount. It's 60 right now. But you got the Fed tiptoeing, trying to reduce its balance sheet by 10 billion a month, and they're going to try and increase that. But I was just reading on Business Insider, Jim, before the call. In October, this is the first month. This is the first month they're supposedly reducing their balance sheet. But guess what happened? Do you think the balance sheet went down like they said it was going to do? No, it went up $10 billion. So anyway, the month's not over, but the central banks have really, they put the bear in hibernation. Now we're going to see if it wakes up as central banks try and stop distorting markets, although, they're in no rush to do so. But you've got an American government that's realized, look, we have to pick up our defense spending. We've had it flat now for a number of years and, off its peak. And when you see China continuing to grow its defense budget by about 7% a year, and yes, the Chinese defense budget is smaller in absolute terms than the U.S. budget, than the U.S. defense budget. One yuan in defense spending in China goes a lot further, I think, than $1 in defense spending in the United States. The Chinese are a little bit more efficient and a little bit cheaper in banging out ships and the like than the Americans are. Americans, they roll out Cadillacs and with the assorted options and bells and whistles, and every ship they build is pretty expensive, and every plane they build is pretty expensive, and the Chinese, I think, are able to kind of crank out their capital, the capital formation of their armies and navies a little quicker and a little cheaper. So we've got a mini arms race going. I just don't see that being consistent with this narrative that we're doomed for deflation. Look, it may not be great for economic growth, particularly in the United States. I'll have to see how big their tax cuts are. And I think we will have a tax cut there, and which will be quite interesting. Let's see how this defense spending goes, and how China reacts, and how Japan reacts, and how Indonesia reacts. No country can just kind of sit there and watch their neighbors sort of build up arms. Unless you want to be bullied in that neighborhood, in the East China Sea and the South, and the South Pacific. So you really got to decide whether you're going to be in the game or not. And most politicians don't like to be be seen as being weak, and you've got you're going to have a lot of pressure on defense spending, and that's inflationary, which is not very productive. It's unproductive, but it requires a lot of basic materials, and requires a lot of people, and it's inflationary. So there's no wars going on, but there's certainly a lot of background noise in terms of conflict, in cyberspace and the like. But when you look at what's going on though in the oceans in Asia, there's also lots and lots of conflict on the open seas. That's that's going to, it's not going away anytime soon. It doesn't look like, and that's going to require stronger navies, and that means building more ships.
We'll have more with Ted Dixon right after the break.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp, RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
Welcome back. We're talking to Ted Dixon. So, Ted, what has been the big driver to make the Canadian economy stand out compared to the rest of the G7?
Well, there's a couple of things. The oil price has found an equilibrium here. I mean, it's sort of kind of stabilized, and so that's allowed not for a boom in the oil patch by any stretch of the imagination, but you've had companies that have been able to commit capital, and some have boosted their capital, others have kind of pulled it back. But you don't have we don't have a deer in the headlights kind of scenario in the oil patch at this point. We've got kind of disciplined growth, and so that's good. It's not overheating, and you're still seeing some growth. No, it's not like we had back in the go-go period, 2013 and early 2014. But it's positive, and that's helping. It's Alberta and Ontario are the two major engines in the Canadian economy, and it's good to see Alberta back on its feet. And the Ontario economy, is plugging along thanks to these handouts from Ottawa, and it's a well-diversified province. So despite very bad public policy decisions that are being made in Queen's Park there, something we keep talking about, the best advantage that Canada has is its workforce, and Ontario's got an amazing workforce, highly skilled, not expensive. Same with Vancouver, for that matter. Hopefully we can keep our workforce here, if we find a place to live. But the Ontario economy is doing pretty good, pretty solid, and even Quebec, when they stop raising taxes, it's amazing even Quebec can kind of contribute. So, we just have a nice alignment of some fundamentals on the ground, combined with this kind of fuel that Ottawa's throwing on the fire. Now, we can have a whole discussion about whether it's necessary or not. That's a political discussion. Fact of the matter is that's what's happening, and so you play the cards you're dealt with, not the deck, not the hand that you'd like. And in Canada, we've got pretty strong growth. Bank of Canada, it's going to have its inflation. We don't know when, and plus these inflation numbers are all kooky anyways, especially when you look at how they calculate their core inflation numbers. I mean, what a joke those are. But there's going to be inflationary pressure. There's going to be global inflationary pressure. We're still seeing loans, social financing loans growing in China. I know I've seen some data that the Chinese money supply is falling. Well, the growth is falling, the money supply is not falling, which is true. But their loans are quite healthy. I don't see any sort of evidence of a credit contraction in China, and we already know there's a bit of a targeted easing coming in the new year, where the required reserve ratio for banks is being cut if they're lending to small business and farmers. So, China is still doing its thing in terms of helping global growth. That's good for the Canadian resource economy. It's great for the forestry industry, to have a little bit more of a market for softwood lumber. Although, ironically, we just had results from Canfor and West Fraser Timber. They blew the socks off of estimates and delivered great results. And why is that? Well, the Americans, they've done this protectionist thing, slapped on these duties, but guess what's happened? The price of lumber is soaring past 10-decade highs. So who's really being hurt here from this protectionism in the U.S.? Well, yes, we know Canadian workers paid a price through some cutback in operations, but it's the American consumer, and I don't know if they're ever going to figure that out in the United States, probably after it's too late. But no, it's a policy that's totally backfired. The forestry stocks have been roaring. They've been leading the Canadian Insider Index to record close after record close. We had another record close yesterday. Doesn't look like we're going to have one today, but we're way ahead of the Toronto's the S&P TSX Composite in terms of hitting record closes, and that's because we're looking at the kind of mid-cap side of the market, stocks that are preferred by insiders, and they're doing quite well. We're up, the index is up about 8% this year on a price basis, close to 10%. On a total return basis, including dividends. So, the Canadian market is showing signs of life here, and given the juice that the federal government is throwing on it, given what we're seeing in industrial metals like copper and zinc and even tin, which is hanging in there. It hasn't made a new high yet, but it's hanging in there. It hasn't rolled over. So long as we've got some upward pressure on those base metals, so long as we got a federal government handing out the cash, this economy is going to have a fire lit under it.
We'll have more with Ted Dixon right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're chatting with Ted Dixon. Ted, what about crude oil?
Well, the crude oil market seems to have stabilized, and we don't forecast, and I don't know if you can. It's very hard to forecast crude oil, and our take on it is, look, we've had some good insider activity in the space. It's finally kind of, after a lull, we had a while where we just couldn't see a lot of oil and gas stocks hitting the high end of our rankings. They just weren't there. They were in the middle of the pack, maybe upper middle, some of them. We had a few come up and get in the top 10% of the rankings. So, the oil and gas sector is back. It's not back in a big way. It's back in a healthy way. It's kind of, it's pulling its weight in the market now in terms of opportunity. But, I don't, are we going to have a breakout in oil? I don't know. We're not getting the excitement in the oil patch amongst insiders that we're seeing in the mining space. I mean, we're seeing a lot of excitement in the mining space with insiders. They're getting into private placements. We've got very interesting developments going on even in British Columbia right now with the mining area. So we're seeing some good insider activity in a couple of junior mining plays in northern British Columbia that it's base metal mining plays. And if you go on Canadian Insider website, you can see where Eric Sprott has been buying. He's been buying into a number of couple of British Columbia companies that are looking for nickel and base metals in gold in northern British Columbia. And so it's interesting. This is the type of excitement we're seeing now in the mining area. We have a what's called a Money is Moving feature on Canadian Insider. Your listeners it's free. Just go on and take a look at our Ink Edge is kind of our premium filters where we highlight some insider buying. We put some of those on the Canadian Insider site for free. But also we have a private eye feature where you can see what companies insiders are buying in the private placements, and you'll see a pretty consistent level of interest amongst insiders in the mining area, and it's enough for us to detect a trend that they're pretty upbeat, and these pullbacks are probably good entry point opportunities if you have the risk tolerances for that industry. I think we're a pretty good space right now. And we're more focused on the base metals, or diversified metals, gold, copper, nickel, those types of plays right now, because of what we talked about earlier in the show. We really we sense, first of all, the insiders are quite active in that area, which is kind of ignites our thinking, and we think, well, why would that be? Well, because I think we're going to see signs of old-fashioned inflation. When I mean old-fashioned, I don't mean the Phillips curve inflation that you keep hearing these central bankers talk about. if only, the workforce participation, would behave, then we could have some inflation and we could push up wages and la la da. Look, we're going to have inflation, I think, because governments are getting into the act, and governments spend poorly. They spend inefficiently. They throw all sorts of money at things that are unproductive, and that's where you get your inflation. You're going to get your inflation from, and but we don't know when. But we're pretty confident it's going to materialize over the next couple of years. But it could materialize sooner than that. We'll just have to see. A lot will depend on what the Americans do with their budget. If they do pass this $1.5 trillion cut to their revenues, that means they'll be flooding the markets with debt. They'll be spending it on defense and tax cuts, which we hear are going to be targeted to the lower end, and that means people will spend it or pay off debt. But the Americans are in much better shape on their household debt than we are in Canada. I suspect a lot of that will get spent. That's going to help car and auto parts stocks. It's going to help the retailers. We've seen a nice move in Walmart, for example, and there's others that have moved up as well. Partly in anticipation of that, and I think also in part that Amazon's kind of hit the wall here. This whole thing about a second headquarters and here send us money, we'll move our headquarters to your city, this just strikes me as either being a hugely overconfident about their future, or they know that they've got to really start cutting their costs even more, so they're looking for low tax, high subsidy jurisdictions to help keep their costs in line. So, we're going to have an interesting situation in the U.S. For sure, where if these tax cuts go through, you're going to have consumers with some more money in their pocket, and that'll pick up retail activity in the U.S. So it could be heading for interesting times in the next few months, Jim. We'll just have to keep our eye on that, on those inflation numbers, and I'd be surprised if they don't start moving up, so when the timing of that is uncertain, but that's the nature of inflation. It's just going to start to pick up some momentum at some point, and then we'll see how central banks respond then.
Ted, thank you so much for being on the show.
Well, thanks for having me back, Jim.
My guest has been Ted Dixon, his website, CanadianInsider.com. If you have any questions for us, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.